Welcome to Entrepreneurs, Executives, and Eccentrics, a podcast dedicated to the stories, strategies, and secrets of remarkable individuals. Join us as we engage in enlightening conversations with intriguing entrepreneurs, accomplished executives, and fascinating eccentrics, exploring their journeys, triumphs, and the unconventional wisdom that has shaped their success. In this episode, we talk with Aman Verjee, founder and general manager of Practical Venture Capital, and a longtime finance executive whose career includes PayPal, Sonos, and 500 startups. We explore what centuries of financial bubbles can teach us about today's AI boom, why some bubbles leave lasting value, and how new technology reshapes jobs and industries. Aman also shares why AI literacy may soon become a basic skill for nearly every career.
Hello, Aman. Tell me who you are and what you do.
Hey, Scott. How are you? So my name is Aman Verjee. I am the general manager and founder of a venture fund called Practical Venture Capital. We're a secondary fund. So we are buying out limited partners from funds that we like, giving them early liquidity, buying out shareholders and executives and companies that we like, again, kicking them out of companies before they exit and giving them early liquidity. That works for them because they can be invested in companies and funds for a long time, and getting some money off the table might fit their strategy. And we're able to get into hot companies at discounts to their last price round. So that's good for us. And I've been in the finance world for 25 years now in Silicon Valley and in the Northeast in New York.
Yeah, your thesis is skipping the J curve, right? Skipping that initial giant outlay, and then on the uptick when it becomes profitable, you're like leaving all that behind. And then you're kind of an aggregator of these PE firms that kind of got in and experienced that pain early, right? And you're kind of near the profitability side of it.
Yeah, it turns out
right?
that the first 5 years or so, especially in a venture fund, tends to be tough because you're writing off for losers, you're pulling fees and expenses out of the fund. The winners may not have emerged yet. It can take 4, 5, 7 years for companies to get from the seed stage to Series A to B. B to C is really when you start to know who the winners are. And by that time, the field is narrowed. And then the fund begins to accelerate. You referenced the J curve, so an accelerating IRR curve. When you get past year 5 to 7, usually you start to see the returns get better because you're written off the fees and the losers. Your winners begin to take over the portfolio, so your returns begin to mirror what the winners look like. And that's usually when we like to jump in.
But there's probably other things, like you finally got rid of the founder. There's a couple of other possible.
Yeah,
you know what I mean, though, right? There's other things. There's probably other things going on there that maybe there's like the 5 or 10% of the drag of the whole J curve. And the last 5 years is that I finally capitalized. We finally expensed that. That's behind us. We're now profitable in some way, shape, or form.
Yes. Yeah. To be clear, we love founders. We don't normally try to get rid. We're actually very passive investors, so we don't take active roles or board seats. But what does tend to happen is a self-selection Darwinian mechanism where by year 5 or 7, if you haven't yet hit, product market fit with the right team and raised financing from the right people, usually those companies resolve themselves. And what's left in a portfolio, the power law, which you might know about, your audience might know about, the winners begin to dominate the portfolio and drive all the value and all the returns. That's especially true after year 5. So that's when you're jumping in there, you're usually betting on at least a highly visible portfolio. And a lot of the bad stuff tends to shake out well before we're into a fund.
Yeah, it sounds like a much more fun place to be if you're aggregate buying this place. It's like winner, as opposed to, I don't know. It's kind of hard to see, but after 5 or 6, it's much easier to see. Okay, so let's make sure everybody understands a little bit about you. Can you kind of tell me how you entered into, I guess into the lexicon of the internet? Like, when did you enter into PayPal, into that larger kind of world? And how old were you, by the way?
Yeah, it was right at the dawn of the internet, really. I was at Stanford in the mid 90s, and I met Peter Thiel while at Stanford. He was in the grad school and I was undergrad. And so we met through just similar friends and social interests and political and ideological interests. He started a college newspaper called the Stanford Review. He was founder, editor of that in the late 80s. By the mid 90s, when I got there, I became a writer, then the editor. And that group included not only Peter, but Keith Rabois and David Sachs and Joe Lonsdale. A number of folks have gone on to do great things out of that early Stanford group. And then Peter and I stayed in touch, and I went to work on Wall Street in the late 1990s. I got my training in financial engineering at Lehman Brothers. And then investment banks at the time had this practice, I guess maybe they still do, is you have to go get a grad degree before you can go become an associate or a VP and keep moving up the chain. So I went to Harvard Law, got my grad degree. On my way back out and on the way back into Wall Street, Peter intercepted me and he said, "Hey, I've started this company called PayPal. We've merged with Elon Musk's company X.com. We're on the road to go public." This is 2001 now. We're on the road to go public. And so I joined on the finance team, really the junior guy on the deal team of that IPO. Company goes public in 2002. eBay acquires the company later that year. I stayed on. A lot of the early PayPal mafia left, but I was young. I was having a good time. I had 4-year options, hadn't invested yet. So
Wait, how old are you? Out of curiosity, how old are you?
I don't really talk about my age. I'm old enough that
Okay.
I'm getting closer. That birthdays are not fun anymore. I'm not celebrating. Getting older now. I'm trying to stay young in
I'm
mind.
52, and I look every day of it. You do not look bloody 52. You look. It's very annoying. You look quite young. It's quite aggravating because I know you're older than I am. I'm falling apart. I'm falling apart.
You go to the gym every day. It's all mindset. But I'm not that far from you. But what did happen was at that time, the internet was just coming around, right? This is the .com craziness. PayPal made it. A lot of companies didn't, and I happened to catch on to the right company at the right time. And then 9 years later, I was running finance for PayPal. And so, and then I left PayPal and was the CFO of Sonos, the consumer electronics company, wireless sound systems.
Big fan.
Yeah. You know him. Hopefully, you've got him in your house. Did a couple of other CFO jobs in the Northeast. Came back to the Bay Area to join another early PayPal guy, a guy named Dave McClure, 2-time member of the Forbes Midas list, founder, CEO of 500 startups. Dave and I run 500 startups together for a couple of years, and now Dave and I run Tractable Venture Capital together.
So it's funny. Yes, you are absolutely OG. You're absolutely you're a very rarefied air. But you're definitely not the type of person that would write on bubbles, right? I mean, typically that's a historical thing, but you are a professor. But it's just funny how, you're a venture capitalist, right? It's not typically someone who, I don't know, I always think is maybe a historian would write something of this. So let's kind of jump into your book just for a moment. Where did you come up with the idea that you were going to write, I guess, kind of the seminal work on bubbles? Like, when did that come to you?
Well, one, I do love to write, and I've always loved to write. I never really gave that up, although my day job is running a venture capital firm and being in finance. And then, in that capacity, that is your professional métier. But I never gave up the passion and the interest of just on my own, reading and writing and thinking about different things, especially around economic history. I've always been just a fan of history in general, economic history in particular. Did actually write a book back in 2004, a political book. Right at the peak of the election between Bush and Kerry. The name of the book was Thank You, President Bush. The book went to the number one of the bestseller list, at least for political books, and then quickly went away because the election was over and nobody cared anymore. But that was interesting. It was fun, and I got a chance to write something with a colleague named Eric Jackson, who's another early PayPal guy. I never really got that bug out of my system, and so I always had it in my head that when I get the chance, I'd like to write another book. This one began to come about in 2020, 21, when we were at the peak of another bubble. In the book, I call it the Everything, Everywhere, All at Once bubble. I'm also a movie fan, but this was a multi-asset class, multinational bubble, the likes of which we hadn't really seen before. But it had similar patterns in 2008 and to 2001. And when Dave and I were thinking about how do we invest at these valuations, do we invest at these valuations? Dave had the argument, which made a lot of sense, which was we were paid to deploy capital. We're collecting management fees. So the more we raise, the more we deploy, the better off we are. And we're not really paid to time the market and these broad macro trends. We're paid to pick the winners. And if we invest at the top of a cycle and we still outperform everybody, so we're a top percentile, top quartile fund, top decile fund, it'll all be fine. And I thought about that. And it's like, that makes sense. I'm having a hard time arguing with that. But I did think, having thought about it overnight, I thought, we actually might be at the top of a once-in-a-generational bubble where these asset prices will just go away. And if we invest at the top of that bubble, surely we're not doing our jobs either. So to persuade Dave, I actually wrote out, the notes on what and why this was a bubble, how it compared to 2008 to 2001, how long this might be. Do we deploy capital? Do we call money and sit on it, which will make our LPs very angry, unless we avoid a bubble, in which case they'll be very happy. But there's going to be questions. So I wrote that first chapter. And then I got interested in it and wrote the second chapter around 2008. And then I thought, why am I stopping at, 2008? We're getting a lot of questions from our young managers and just other folks who are in the space about AI and about tech valuations. Can they hold up? Surely this time is different. And they were making the same mistakes that I remember the internet making back in 99 when Dave and I were actually old enough to live through it. And so I thought, have you guys not studied the 1999, 2000, 2001 episode? And these are kids who are in their mid 20s or upper 20s. So they weren't, they were born when, let's say in the mid 90s, they weren't really of age when that bubble happened. And they didn't really learn about it in business school or in college. So I'm like, I think they just need this education so that they can recognize patterns and avoid some of the obvious mistakes that we don't want to replicate in 2021 versus 2001. And so I thought the world needs a book that people will buy, will relate to, will understand. And I ended up doing 10 bubbles, going all the way back to 1636, 37 in Amsterdam, and just detailing what happened, why, causes, consequences, similarities, differences, and doing it in a way you don't have to be a PhD in economics to understand this book. I'm not going in deep into asset pricing, valuation scenarios and stochastic models. I'm trying to tell a story of why a bubble happened in a way that virtually anyone with a modicum of interest can understand.
General prosperity, concentration of wealth, and easy money. It's how you lay out. That's the thesis. Now,
Yes.
When you were doing, so you strike me the kind of person that just goes all in, right? In terms of the research, did you come across something that you're like, this can't be freaking true? Like, it was just something you came across that you couldn't even believe, and you had to go kind of figure it out.
There were a couple. Yeah, there were a couple where the more you get curious about a subject, the more you start with the received wisdom and what people wrote at the time of the bubble. And like a good example would be 2008, 2009. I remember living through it, and you hear a lot of conversation, and it's the topic du jour. And at that time I was old enough to not have a house or have a mortgage. But I was at a point when I was in the market and I was working at PayPal, and it was affecting all kinds of people around me. So you got a very clear sense of what people thought were the causes and the consequences, and it's in the pop culture. And I began to read about it at the time, and I knew I'd say a fair amount about the housing market because of my Wall Street days. But I was a tech executive, so I was a little bit removed from all the investment banking mania that happened. And then there were studies released after 2010, which I think were also illuminating and began to paint a fuller picture of it. And then I did my own research on it, and I really came to a conclusion that I think the received wisdom, the conventional wisdom around 2008, 9, 10, really got that wrong, from politicians all the way to the economists to the bankers, and that there was a minority group that was actually much more convincing, but a rigorous analysis of what happened made me kind of flip around to that point of view. So you learn a lot about, just the different sides of these debates, and putting it in that historical context, I think gives you a good way to think about and frame these things.
So chapter one's tulips. Is that chapter one is tulips?
Yeah. Yeah.
So if I remember correctly, it was along the lines of how everybody gets it wrong and how entire mythologies were created around this, by the Puritans that kind of left and went off to the States, of how the dangers of gambling and how,
Yes.
it was this kind of broad, and it really wasn't. It wasn't broadly societal. It was just a handful of really wealthy merchants and people that grow these flowers. That's it. It didn't bring down the entire economy. Is that right?
That's right. I think if you read the histories of the Amsterdam tulip bubble, at the time, there was a lot of criticism about the behavior. So, one thing to reflect on is it does turn out at the top of these bubbles, people will talk about, hey, we're in a bubble. And you have to wonder, why is it that people are saying we're in a bubble, and yet, some people are actually participating in this irrational behavior, even while they're being called out. That's kind of interesting. Like, people are talking right now about an AI bubble. It's not a mystery to folks. Same thing in 1636. There was a deep conversation, and there was a conversation about, are we in a bubble, and what do we do about this irrational behavior? But people kept on doing it all the way through late 1636. The price of tulips begins to go up and go up and go up. And I point out why. And at the peak of the bubble, the price of a single flower, the most
One house
sought after, the most sought after of the tulips, is basically a house on the Amstel River in Amsterdam, like the most valuable property in the world at the time, in the richest city in the world. And it just becomes this ongoing phenomenon, but the prices go up. And then in about February of 1637, it all kind of ends. There's a couple of broken auctions where all of a sudden, in an auction house, a tulip that would have sold for a couple of thousand guilder doesn't sell at all. The price gets cut to 1,500 to 1,200 to 1,100 to 1,000, and there's just no bidders. and the market just goes away. And it's really the space of about a week in Amsterdam and in Haarlem, where the market just rolls away, and it goes away as quickly as the brittle fog coming in over the Amstel River. If you've been to the Netherlands and you've seen the weather there, you know what I mean. And there's no catalyst for it. It's not like there's a credit squeeze. It's not like there's an interest rate hike. There's no other information coming out about tulips. The market is just very finicky, and it just comes and goes. And then in the aftermath, there's a lot of discussion, and you can see it, about how this is a retribution for misbehavior. And there are stories about people committing suicide and about the strife that it causes and the economic uncertainty and anxiety that it causes. And then McKay is a very famous economist, writes about this. And in his book, he basically points out, he goes through all the madness of crowds and, all the same singing song and dance about how it is that the population just acted irrationally and then had its comeuppance, and it caused a lot of chaos. And there was a certain, biblical retribution around it. It feels like people misbehaving and then getting punished by the market or by providence. And then you look at, well, where did McKay source this information from? And it turns out it was a lot of Puritan literature, people who were very much into the religious aesthetic of modesty, and they were critical all along. And so the story that they tell was that, well, of course, the behavior ended badly, and of course there were negative consequences, and metaphorically, people got justice. They went to hell. But you look at the number of bankruptcies at the time, and Anne Goldgar has written about this. She couldn't find any bankruptcies that happened in the aftermath of the tulip bubble, which was surprising. Like, you would think the florists and the growers and the people who had this inventory would have declared bankruptcy, at least they would have had some kind of strife. But it turns out at the top of the bubble, what was actually being transacted wasn't so much tulips or these bulbs for these exorbitant prices. It was forward contracts. So I would buy from you, Scott. I'm going to promise to buy you a tulip. I'll give you 10% down now, but I'll promise the other 90% later. So you're buying it on spec. So what ended up going up in value was the paper value of these tulips, the paper value of the forward contracts, but not necessarily the actual value. And then when the prices crashed, people just reneged on the contracts. And so I'm out my 10% deposit, but I'm saving myself the 90% of the value. So now, Scott, you're going to come to me and you're going to say, hey, you owe me, the value of the tulip you promised. The other 90% I'm here to collect. And at a certain point, courts stopped enforcing those contracts in the middle of 1637. So by not enforcing the contracts, they ended up avoiding mass bankruptcies and then all the other strife. And if you look at how the overall economy of the Netherlands went, it grew in a straight line, more or less, through the 1630s into the 1640s. This was the Dutch Golden Age. It was the age of seafaring, of exploration. The Dutch guilder had just become the world's reserve currency. The Netherlands was the richest country in the world, probably twice as rich on a per capita basis as either England or France. And you don't see that stop in the late 1630s. You don't see them hit a recession. You actually see just a mini bubble in Amsterdam and Haarlem, maybe a couple of other tiny cities, and that's it. And the rest of the economy seems to clip along at a pretty good pace through the 1640s and 50s and 60s. And so a lot of the negative drama that surrounds that whole Amsterdam post-mortem turns out to be, I think, Puritan literature through the imagination of Charles McKay, and it just sort of had a life of its own, but doesn't really stand up to empirical economics, which, to be fair to them, wasn't really around in the 1630s. It doesn't come around until maybe Adam Smith in the 1770s. So at the time, there's a lot of sermonizing, but not a lot of empirical economic research.
I dug the way how you painted where these auctions were being held. It was this grimy, kind of gross. They were half drunk a little bit. I know, but you could see as a Calvinist, you'd be like, right? That's probably, they had kind of a poor opinion of it to begin with, right? So it was such an easy target to go kind of pull. You're like, all these grandiose, simpler Augustus, or these very grandiose names for this thing that had no intrinsic value as far as it just felt. It was gambling. Yeah, I'll give you 10%. I'll go, hopefully I can buy it for, 80% less right before the contract's due, and I go sell it. Buy low, sell high, right? Gambling, gambling. And you can totally see how the Calvinists would definitely go kind of poo-poo that.
It did take on a life of its own. It was a very sophisticated financial market. Up until the 1620s, they were being priced by the bulb. And then after that, they were buying the offsets, which means that it's whatever comes off of the mother bulb, but then they were buying it by weight. after about 1634, it was customary to price by weight, and they were sold in units that were very carefully measured. So there was a lot of analytics to it. But at the top of the market, the Semper Augustus, the tulip that most bedazzled Dutch traders in the 20s and 30s, got up to 5,000 guilders, which was, more than you wouldn't pay that for a house in the fanciest neighborhood. And so there was just a lot of, the behavior that attached to it, even though it had the veneer of analytical and economic responsibility, did become like, I don't know, trading baseball cards or maybe crypto, something that doesn't really have an intrinsic value, but just becomes something that gets bid up. And the Puritans, I think for the most part, were against these ostentatious displays of wealth. There were actually stories that I talk about in my book of travelers from London who come to the Netherlands. And they're like, I don't know who I met. I met what I think was the richest merchant in the town, but he looked, based on his demeanor, based on the clothes that he wore, based on his wife. I don't know that I couldn't tell him apart from, your typical blacksmith down the street. Whereas in Paris, if you had wealth, you would wear silks and these beautiful clothes. And this was the height of fashion and then art. And then your horse carriage would just tell you where you are in society. Are you in the nobility? Are you a peasant? You can tell, but based on, what a person's wearing. But that wasn't true in the Netherlands. They didn't have the same ostentatious displays of wealth. And that's because this Calvinist Puritan culture, was very critical of it and dismissive of it. And so the only things that you could really spend on was a house is okay. No displays of wealth like silk and fancy horses and all these other outward displays of materialism. But a house is fine. What do you have in a house? Well, you have a garden. What do you put in a garden? Flowers. Okay, so flowers are safe. And horticulture was all the rage, and the Dutch Golden Age gave rise to the science. And so it's just this perfect synchronicity of different events that creates a tulip bubble. And that's why it happens in Amsterdam. It doesn't happen in Paris. It doesn't really happen in London, because they have other things to spend their money on, and it really concentrated in the Dutch Republic.
Yeah, it's very black, white, and tall hat with a funny buckle. That's pretty much what you were wearing back then, right?
That's it.
But France was like, no, we're the center of fashion, and you have to show wealth, you have to display wealth, and all those kind of things. So, what was it of the 400 years that that you've studied? Were there any other just like this camp? This is what right bonkers kind of activities or kind of stories you found along the way?
Yeah, the UK railway bubble was interesting. I was fascinated by how quickly that technology got adopted. And I was just surprised by the level of capitalism and the way that technology story moved and attracted capital 150 years before the internet did was just interesting just to see how these tech bubbles form and the patterns between UK, the internet bubble, and today. The other one my favorite chapter was actually the longest one was the 1720s South Sea bubble and the Mississippi bubble, which were just amazing. The characters behind those two companies, each of them at their peak was worth, in terms of the size of the economy and let's say today's dollars, South Sea Company and Mississippi Company were both more valuable than NVIDIA is today. At its very peak, the Mississippi Company was probably around $10 trillion in market cap versus NVIDIA's $5 trillion. The South Sea got kind of close to that, around 7 or 8. The South Sea Company, they kind of went first. They were formed in 1711 and were essentially a British chartered company that had a monopoly on the trade to the South Seas Company, to the South Seas the South Sea territory in Spanish South America. And a lot of that was the slave trade, but it also had just goods and services and cargo. And so they built on that trading monopoly, they built potentially a very valuable company, but they never really got their operations off the ground. They never really turned a profit on that whole business. But beginning in 1713 and 1714, they were able to raise money on the prospects of this profitable company. By 1717, they've got the imprimatur of the King of England. They've got members of Parliament that are involved, that are buying the shares, that are sitting on the board of directors. There's a whole bribery scandal around this. And they become this massive joint stock company in operation, which by 1719 becomes the most valuable company in the history of the world, rivaling the Dutch East India Company, which did have a real operation and real profitability. And then right next door to that is the Mississippi Company in France. And the French see what the English did. And they're like, well, we have to do that. If they can do it, we can do it. We've got all these war debts. How do we retire all these war debts? Let's just raise a great big, massive company, a royal monopoly, use that money to retire our war debt. And they actually outdid the English and made the Mississippi Company even more valuable. And then in 1720, it all kind of goes away. And there's just a lot of interesting lessons in there about how to build these companies, how to market them. John Law is the general manager of the Mississippi Company at its peak. And he engages in just a tremendous amount of marketing, much of it deceptive marketing, but let's just call it hype about the prospects of the Mississippi Company. At its very peak, he converts to Catholicism so he can hold a government job, and that government job is to be the general manager of the bank. He was the founder and the first guy to essentially run the Bank of France, the Banque Royale. So this would be like, giving Elon Musk or Jensen Huang the keys to the Federal Reserve. Imagine
what could go wrong.
Yeah, imagine how much power in one person's hands. And so what could go wrong? Of course, John Law being the he was a financial genius, but also a bit of a rogue and a scoundrel. He just ends up printing a bunch of money out of the Banque Royale, uses that to finance the Mississippi Company, and creates a bubble so big that it actually takes over not only France, but England and the South Sea Company. And by the end of 1721, both those companies are essentially zeroed out.
It's also, it also caught up Sir Isaac Newton, right? He lost something like, it was $20 million equivalent in money, in a single afternoon. Like, well, if Sir Isaac Newton's doing it, it must be okay. The king's doing it, it must be okay. That's South Sea, of course. It kind of reminded me, and by the way, it is an excellent chapter. It sent me off in the direction of my thought was, one day we're going to be mining gold or platinum on an asteroid, but we don't know if it's there, and we don't even know if we can get there, but it seems a little bit similar. Let's go raise capitalized trillions of dollars because there's gajillions of dollars on the asteroid that we can't see nor touch. It's in some future state, right? And that we may or may not be able to mine. And that, I don't know, that's kind of the modern equivalent to the South Seas. Because, of course you jump in, right? Maybe you would, maybe it's going to be, we don't really know. Absolutely fascinating. I'm going to get to that entire book here in the next week. It's just, it's really good.
It is interesting. It is exactly the same analogy to, I guess, oil and gas companies or, gold, prospecting for gold. There's the prospect of profits. And somebody as smart as Newton, he was right in the middle of it. He was not just a passive investor. He was actually playing a supporting role. By the time he was your age, you said you're 52. By the time he was your age, he'd already, he'd written the laws of motion and he explained orbital mechanics and he'd co-invented calculus. And then somewhere in his early 50s, he experiences a mental breakdown and he basically is beset by rages and sleeplessness and prone to writing ranting letters. And so, but coming out of that, King William III gives him what it was supposed to be an easy job, which was the warden of the Royal Mint. And so he's responsible for producing all the coins of England at the time. But, in that, he gets involved in the South Sea Company and he invests about 40 million pounds in, today's money in the scheme. So most of his net worth goes into the stock. And he actually ends up buying and selling and trading out of it and then regretting the fact that he sold too early. And then he jumps back into it in the summer of 1720, right at the peak. So someone as brilliant as Isaac Newton is caught up in the mania. And one of my favorite quotes from which I talk about in the book is he says, or it's attributed to him. He says, "I can calculate the motion of heavenly bodies, but not the madness of people." And so it just, even though you have this prospect of wealth and this prospect of treasure in the South Seas, it is speculative, and they never got the operation off the ground. And the Mississippi Company did, I think, a okay job of getting a real operation off the ground, although again, expectations ran ahead of reality. And then you have the Dutch East India Company, which in the early 1600s actually did have a real business and made a ton of money, and they made their investors a ton of money. So there was a pattern of 100 years of, hey, this could work, but it just requires execution and a level of ruthlessness to build these empires and to build these trade monopolies that neither the South Sea Company or the Mississippi Company, ever matched. But they certainly got the imagination going.
My favorite Sir Isaac Newton story is that he forgot he invented calculus and then wrote Principia 10 years later just to put the thumb in that eye, that one mathematician out of Germany. His level of autism was breathtaking. I'm going to get some hate mail on this. So anybody who's listening to this, maybe it's 5 years. I'm pretty sure it was 10 years, right? But it is just, if you've ever tried to read Principia, he literally wrote it so he didn't get questions from dumb people. He made it so complicated And that if you tried to actually approach him on it, he would be clear within 13 seconds that you know what you're talking about and he just dismiss you. His favorite way of being approached was sitting next to him, not looking him in the eye, and just saying something smart. And that's something how they would meet.
That's how you sneak up on him.
Absolute maniac. But so you talk about, so you kind of form this thesis by the time you're in the third chapter about how there's this valuable bubble and not valuable bubble, right? And one would, I think you argue rightfully so that the railroad bubble left behind infrastructure that literally added into the Industrial Revolution, all the kinds of things, right?
Yes.
But and then there's the not useful bubble, like I guess the Australian land had a bubble that it didn't leave behind infrastructure. There was nothing valuable, right? So let's fast forward to, let's say, I don't know, about 3 months ago. Where are we as kind of like, how can you kind of rectify where we are AI wise and where we're going? And you don't have to take a hard and fast rule, but is there some historic comparisons we can kind of talk about in terms of where we are right now?
Yeah, I think there's two examples I call out of, let's call them positive bubbles, what I call positive bubbles. So the tech boom in the 1990s, and then the UK railway boom, which you referenced, I think are the two best examples. And both those are positive. Why do we call them positive? Because there's a lot of investment in a short amount of time that went into a defined space, but it did create a technology that people found useful, that people paid for, and that ultimately left value in the world. In the case of the UK railway boom, there was a 4-year period from 1845 to 49 where they just built and laid a lot of track. And they knew that the railways would be big. The investment prospects, I guess like the South Sea Company, were enticing. All of a sudden, investors started flooding in. The amount of money going into that economy at the time is about 25% of GDP over a 5-year period. And the amount of railway that gets laid is massive. Like in 1844 and 45, the UK green lights 3,500 miles of track. That's more than the past 15 years. All the stuff that gets financed the next 4 years is 24,000 miles of track. The UK is a tiny little country. Just for context, they eventually get around to needing 25,000 miles of track, but that's not until the 1920s. So in a 5-year period in the 1840s, they build basically all the track they need for the next 80 years. But everyone thought that travel would just become this big thing. And so even though there was demand and revenues are doubling and doubling again through the 1850s, they just built so much over capacity that those investors lost money. But the good news is those investors who lost money get priced out. New owners come in to take over those assets. You get some rationalization. And you look at the growth of the UK economy, you do have, when the bubble pops, 1848, 1849, there was a recession that's mostly around the London area. You have the whole Irish potato famine in 1848. That's separate. It's kind of a different issue, although orthogonal. And then the economy goes on a tear. From 1850 to about 1873, it goes into what historians call the Great Victorian Boom, a long period of sustained economic growth. It's led by the tail end of the Industrial Revolution. Railways are front and center, and the country is much better off as a result of what happened in the 1840s. Even though you had a few losers, you have a lot of winners. And then similarly in the dot-com space, in the 1990s, you get all this investment coming into the internet after about 1995, when for all intents and purposes, Mark Andreessen and Netscape invent the internet. It kind of goes from being this closed government technology, the Department of Defense, into a broad open technology that nobody can access and knows how to understand and navigate, to all of a sudden Netscape comes along with the browser that you or I or anyone without a coding degree can now, I can now surf the internet, put stuff on and take stuff off and read and connect with Scott, and I can share information. And boom, 1995 happens. All of a sudden it's game on. The amount of money going into the economy there, not quite as big as the UK railway boom, but it's like 10% of GDP. So not 25% like the UK, but more like 10%. And then you get a bunch of companies formed, and then, get the bubble pops, and again, a lot of destruction of value. But think of the number of companies that came out of that space. If I just go from, just the Silicon Valley ones that I can think of, you've got like, eBay and Netflix and Nvidia and
Oracle
and PayPal
Microsoft,
and Google,
yeah.
and Salesforce is founded in 1999, and Tesla and ServiceNow is 2004, and Tesla's 2003. So all these great companies that come out of that dot-com boom, Amazon in 1997, and Applied Materials and Advanced Micro Devices, like all these companies that had preceded the boom, have their businesses accelerated, Microsoft and Apple. All those companies were able to do well during the boom. They grow their businesses. There's a whole bunch of companies that are founded. Probably half the Mag 7 are founded during that period. And then even out of the detritus of the bubble, it pops in 2001. Even out of that, the profits get reinvested into a whole new business cycle. So as an example, my first company was PayPal. My first two bosses were Elon Musk and Peter Thiel. PayPal does survive the bubble. We go public, it was like a $1 billion IPO, right? It's not life-changing. By today's standards, it's a small IPO. It's not life-changing for most of our employees, but for a lot of them at the top, they had $10, $20 million windfalls. But for the rest of us, we made enough money to know what we were doing, to build a little bit of capital, and then to go on and build something new. Dave McClure goes on to make investments and starts 500 startups. Peter Thiel starts and funds Facebook. That was the first institution. She was the first check into Facebook in 2004, 2005. Elon Musk goes on to found Tesla and SpaceX and The Boring Company and buys Twitter. All that is with .com profits. So you look at the value created over the time in that internet bubble, and compared to the fact that there were some losers and people who rotated out, but who got repriced back in. And it turns out that I think those are very positive for humanity. I think where we're at with AI, it's either, I would say, not a bubble, and we can talk about why, but there is a lot of investment going into AI. And I think it's positive in the sense that you had a lot of people who were playing around the edges of AI until maybe 5 years ago. Google had DeepMind, and they had a lot of technology around artificial intelligence, like machines that learn how to code and predict what you're going to say next. But they didn't release it in 2019, 2020, 2021. They were protective of it. They, I guess, were protective of their search franchise. Nobody wanted to break up this Google search monopoly, right? They're making too much money to endanger that franchise. So they didn't want to release AI into the wind and have another product and technology do something that would threaten their core profitable franchise. Finally, in 2022, OpenAI, which had been around for a couple of years, they launched ChatGPT, and all of a sudden they start competing with Google for search. And now Google's like, okay, well, now we have to release our AI technology to keep up with OpenAI. So even if we are in a bubble, and that bubble brings OpenAI, Anthropic to the fore, and forces people like Google or other incumbents to break open their coffers and start to invest, what you have done is you've broken through a period of stagnation, of technological stasis, and forced a whole new wave of innovation. So if some people win and some people lose, but you break through to a new level of technology that we're now seeing in the ecosystem, I think that could be, again, a very positive economic bubble.
I mean, I don't know. I don't know about you, but it feels like we're experiencing 10 years per year in terms of especially in the last 2.5 years, right? So there was a white paper called "Attention Is All You Need," which was the T in transform. That was the seminal paper, 2017, where everyone's like, "Oh my God, that's it. That is it." Well, the matrix algebra will just do everything that's kind of relational, put it all together, and then a couple of years, ChatGPT is actually something that sure looks like it's going to pass the Turing test. Right, this is a couple of years ago, man. I was told about you, but I was told my entire life we'd never see the Turing test, not in my lifetime, ever pass. And now it kind of happened, like recently.
Just happened. I think it's probably happened for, I got two kids, which we haven't talked about, but I would say and they're 12 and 15, and I would say for teenagers and probably for certainly kids up to the end of elementary school, so 11 or 12. I would say we've passed Turing test. If I were to ask 80% of 11-year-olds, hey, let's have a conversation with ChatGPT or with Solve 5.6 and have it do your homework for you or something like that, they probably can't. They probably feel like I'm talking to a real person, and if I'm not, I can barely tell the difference. And in fact, to the extent that I can tell the difference, I actually like this guy better than talking to my teacher, because my human teacher, isn't quite as precise or as eloquent or as fun as Saul. So you've essentially, for young kids, I think we've passed the Turing test. I think a lot of adults probably, I'm not sure we're there yet. Maybe 80% of adults can tell the difference. Maybe 20% can't. But we are also, but that's, to your point, that's changing. In a couple of years, that'll be different. And if you have a therapist or a customer service operator or a best friend, you may be at a point in the next 2 or 3 years where even those 80% are like, either I can't tell the difference, or you know what, I can tell the difference, but I actually prefer my AI buddy to my real best friend, who can be quite annoying.
Well, I mean, the original test was where you're supposed to write a question, slip it under a door, right? And then a machine would write it back. And that's how, like, I would argue we've definitely got past that, right? That very basic. And please don't let me send me the hate mail. I mean, I'm not exactly right. I know it's a little bit more complicated than that, but I'm just saying the original kind of whatever was you write something on a piece of paper, you put it under, it gets answered. If you can't tell the difference, then bop, you bada bing, bada bing. I'm sure it's more complicated than that, but that's my memory on it, right?
Yes.
I think we passed that years ago.
Yes.
It just seems to be accelerating. And then the access that you democratize it. Oh, we'll put an API on it. So now people they can write apps. I mean, it's just every time I turn around, it's some new innovation. Oh, we've cloned voices. Yeah, we've cloned them. And now you can have an entire audiobook done by a cloned voice. It's almost right. It's close.
Yeah.
That's like 6 months ago, man. That's not even, it's just crazy.
Performance arts and actors and music. Yeah, we could be 5 years away from an AI automated machine writing a best screenplay, an Academy Award winning screenplay. I guess that's contingent on whether the Screen Actors Guild will actually allow them into the contest. They may not want that competition, but we are not far away.
Admit it.
What's that?
A writer will actually admit that he used it to begin with, right? I think it's already happening. Just we'll never know it because it's a tool.
Yes, that's quite possible. But I think all that is. I think my sense is that's all going to be better. Those are all improvements on where we're at right now, and people will learn how to use these technologies and these tools to make themselves better. And you can fear it, and you can be angry about it, and you can be threatened by it. But at the same time, again, just go back to history. If you go back to let's take the technologies of the Industrial Revolution. We did go from by 1800, 90% of Americans are living on farms, and by 1900. You're probably at about 40 to 50%, and by 2000 you're down to 2%, and now we're at 1% of Americans living on farms, and we don't have a 90% unemployment rate. Now, all these people came off of farms, and it was the result of agricultural productivity tools that have made it so that with 1% of people, we're farming all the food that we need, and can have an export surplus. And yet these people have all moved into new jobs and new positions and created jobs, and I would say that, and the reaction of the is like, well, that took 100 years. We don't have 100 years. This is happening by Thursday, and all these jobs will get destroyed tomorrow. And then what will people do? And isn't that a bad thing? But I was recently traveling in Kenya, where I was actually born, and in the space of my lifetime in Kenya, so when I was born in Nairobi, the average life expectancy for a male in that hospital on that day was like 38 years old. And now the life expectancy is like 65. And I hope I live past 65. And so in the space of a generation, right, the medical technology imported from abroad has changed just how they do medicine and been quite literally life-changing. And it's across food and it's across agriculture. Their education system's different. Everyone's got a smartphone in Kenya. That wasn't true, even like 10 years ago. So in the space of a less than a lifetime, technology does change, and people do have all kinds of fierce change around them, and yet they adapt. But I'm not talking about 200 years of change. I'm talking about 20 years of change. And if you don't believe me about the Kenyans, or you think somehow Kenyans are different and America can't deal with it, let's go back to the 1970s. Do you know what if you were a woman in America in 1975, what was the number one job? And you didn't have a college degree. What was the number one job in the business sector that you would have had? Would have been a receptionist, secretary. Personal assistant, we'd call it today, but basically they call it at the time a secretary, receptionist. Hey, talk to my secretary. She'll draft up that letter, Scott. She'll write up the memo, and she'll make your coffee, and she'll do all the work that now you would recognize as basically a typist. And it turns out some secretaries were really good at typing, and some were not. And there was a thing called a typing pool in the 1970s. So it would be writing letters, drafting memos, writing mail and correspondence, but they would put in a pool, and the pool would generate all this activity. And like 1/5 of all women in the workforce at the time in the 1970s were employed as a receptionist or in the typing pool. Well, the personal computer comes along, and in the mid 1970s, late 1970s, by the time you get to Bill Gates and the software revolution of the 80s, personal computers are on everyone's desk by the late 1980s. So in the space of a decade, basically this whole typing pool gets eliminated, and all those jobs essentially become redundant and go away. So what happens to all the women in the 1970s and 80s? Do they just lose their jobs? No, right? Women find other jobs to do. That whole category gets eliminated. But the labor force participation for women in 1970 is 52%. Today, based on yesterday's report, it's like 66, 67%. This is for like working age women between the age of 25 and 54. 67% of them have a job in the workforce, up from 52 in the 1970s. And that's despite the fact that their jobs just went away. The number one job for women got eliminated. So what does that tell you? Well, for every job that gets eliminated, another job gets created and then some. And I don't know what all the AI related jobs are in the future. I think you're going to have to be good at coding and fast solid AI to be employed in the future. But there's a lot of jobs that get created, just like the internet created jobs, like YouTube influencers. And, who knew about all these content managers that would get created? But for the automobile, who would have thought, oh, we're going to need gas station manager, pump attendants. We need pump attendants. We need people to build roads, construction jobs. Like, we didn't know about that in the 1920s, but every technology creates and spawns these new industries. And so that's what I'm actually very optimistic about what AI will do, because I've seen every technology come along that is a positive bubble, creates value, and then people benefit from it.
It's a fantastic answer, Aman. Real quick, as a side note, I was in Kenya last year, in the middle of the Rift Valley, where lions kill people all the time.
Wow.
We were literally with a group of Maasai tribesmen. They have these rebarb. They take a rebarb and they sharpened them and made them into spears.
Right.
We're in the middle of just that. It's very dangerous. And he is on a cell phone. He lives in a mud hut. He's literally on a cell phone calling his wives, right, to tell them that they're gonna whatever. Yeah, yes. I have a picture, and it's just the most bonker. I mean, there's like 100 miles in every direction of no civilization. It's absolutely bonkers. Anyway, we're almost out of time. I have one last question, and I asked this of everybody, so please bear with me here. If you're 18 years old today, knowing about what you know of the future and the past, right? What are you doing? What direction are you going in? What are you telling your children they should go into?
I think the first thing is do what you want. In terms of studying in school, do what you want. And I would tell my 15-year-old, you have to follow your passion, and you know that you're good at certain things. You know you're not going to be good at other things. So really follow and double down on things that you are really good at. The only exception is if you don't like math, or if you don't like computer science or coding or learning about AI, that you have to do. That is going to be like brushing your teeth and doing your push-ups and eating your broccoli. Like, you have to do those basic things to be literate and to be able to operate in the new world. Just like you and I had to learn how to be on a computer and a calculator and a cell phone. We can't just not deal with those technologies. If you are the most AI literate, smartest AI person in your company, you will be of value and you will have a job. Even if your major was, art history or whatever, every company needs people who understand AI, can deploy agents, can make sense of them, can also cut through the bullshit. AI will steer you wrong in a lot of areas in terms of giving you answers. So you have to be able to tell, when it's wrong and when it's right. And anyone who's AI literate, I think, will be employable. I'm not guiding her to major in a certain thing or work in a certain industry, but I am telling her you have to have those basic skills. And then once you have that, I think you just got to follow your passion. I'm not even pushing her to go to college or university. If she wants to, great. I'm here to support. But if not, you want to do something else, that's fine. I think a lot of universities are pushing people in directions that aren't great in terms of the natural course of skill building and the knowledge that they're able to acquire. They're still stuck in an educational system 10, 15, 20 years ago. And, and that's unfortunate. And then you're running up all this college debt on top of it. So what I would just tell anyone is, find what you're good at, what you're passionate about. You've got to have a work ethic. You got to be able to demonstrate that work ethic, and you have to have some kind of AI fluidity. If you do those things, you'll be fine.
Fantastic answer. Aman, thank you for doing this.